Hey everyone, and welcome back to the channel. Today, we're rediving into a topic that might sound complicated but is actually the engine room of our modern economy, the stock exchange. UVA probably heard terms like the market is up or seen those scrolling numbers on news channels. But what does it all mean? How does it actually work? Well, stick around, because by the end of this video, you'll have a solid understanding of what a stock exchange is and why it's so important. So, let's start with the absolute basics. Imagine a giant organized marketplace. But instead of selling fruits, vegetables, or crafts, this marketplace is for buying and selling tiny pieces of ownership in companies. These tiny pieces are called stocks or shares. And the marketplace, that's the stock exchange. It's a platform where buyers and sellers come together to trade these shares in a regulated, fair, and transparent way. Think of famous names like the New York Stock Exchange, or NYSE, and the NASDAQ. These are just two of the many stock exchanges around the world. Now, you might be wondering, why do companies even sell these shares in the first place? Great question. It all comes down to raising money, or what we call capital. Let's say you have a brilliant idea for a new tech company. You start it in your garage and it's growing fast. But to expand, you need a lot of money to build a bigger factory, hire more people, and market your product globally. You could try to get a loan from a bank, but that comes with interest payments. Another option is to go public. This means offering shares of your company to the public for the first time in what is called an initial public offering, or IPO. During an IPO, the company, with the help of investment banks, decides on a price for its shares and sells them on a stock exchange. The money they raise from selling these shares goes directly to the company, providing them with a huge injection of cash to fund their growth. In return, the people who bought the shares, now called shareholders, own a small piece of that company. They are literally part owners. This is the primary market where stocks are first created and sold. But what happens after the IPO? That's where the stock exchange really shines. This is the secondary market. Once the shares are out there, shareholders can sell them to other people who want to buy them. The company itself isn't directly involved in these day-to-day trades. It's like buying a brand new car from the dealership that's the primary market. If you later sell that car to a friend, that's the secondary market. The car company doesn't get any money from that second sale. Similarly, when you buy a share of, say, Apple on the stock exchange today, you're not buying it from Apple directly. You're buying it from another investor who decided to sell their share. So how do these trades actually happen? It's not like a chaotic flea market with people shouting prices anymore, although that's what it used to look like. Today, most trading is done electronically. The stock exchange acts as a giant supercomputer that matches buy orders with sell orders. Let's break that down. A buy order is an instruction from an investor saying, I want to buy 100 shares of company XYZ at this price. A sell order is the opposite. I want to sell 100 shares of company XYZ at this price. The exchange's system constantly works to find a match. When a buyer's price and a seller's price meet, a trade is executed and the ownership of the shares is transferred. This happens in fractions of a second, millions of times a day. This brings us to the big question. What makes stock prices go up and down? It's all about supply and demand. If more people want to buy a stock than sell it, there's high demand and the price will go up. Buyers will have to offer a little more to convince sellers to part with their shares. On the other hand, if more people are trying to sell a stock than buy it, there's a high supply and the price will fall. Sellers might have to lower their asking price to find a buyer. But what influences this supply and demand? A whole lot of things. The company's performance is a huge factor. If a company announces record profits, a groundbreaking new product, or successful expansion, investors get optimistic. They believe the company will be worth more in the future, so more people want to buy its stock, and the price rises. Conversely, bad news, like a product recall, a drop in sales, or a scandal, can make investors nervous. They might worry about the company's future and rush to sell their shares, pushing the price down. It's not just about the individual company, though. The overall economy plays a massive role. If the economy is strong, unemployment is low, and people are spending money, most companies tend to do well. This creates a general feeling of optimism, and the market as a whole tends to rise. This is what we call a bull market. But if there's a recession, high inflation, or rising interest rates, people get worried. They spend less, corporate profits fall, and a wave of pessimism can wash over the market, causing prices to fall. This is a bear market. Geopolitical events, new government regulations, and even natural disasters can also send ripples through the stock market, affecting investor sentiment and, consequently, stock prices. To help us make sense of all this, we have stock market indexes. You've definitely heard of these: the S&P 500, the Dow Jones Industrial Average, the Nasdaq Composite. What are they? An index is like a snapshot or a report card for a section of the market. Instead of tracking thousands of individual stocks, an index tracks the performance of a specific group of stocks. For example, the S&P 500 tracks the performance of 500 of the largest and most influential companies in the US. If you hear on the news that the S&P 500 went up by 1%, it means that on average, the value of those 500 top companies increased. It gives us a quick and easy way to gauge the overall health and direction of the market. So, why should any of this matter to you? Well, the stock exchange is more than just a playground for big-shot investors. It has a real impact on our lives. Firstly, it's a vital tool for wealth creation. By investing in stocks, ordinary people have the opportunity to let their money grow over time. As companies succeed and their value increases, the value of your shares also increases. This is how many people save for retirement, for their children's education, or for other long-term financial goals. Secondly, the health of the stock market is often a reflection of the health of the economy. A thriving stock market encourages companies to expand, innovate, and hire more people, which is good for job creation. It also affects our retirement accounts. Many of us have a pension plan or a 401k, and that money is often invested in the stock market. So when the market does well, our retirement savings grow. Of course, it's crucial to remember that investing in the stock market always involves risk. Just as prices can go up, they can also go down. The value of your investment is not guaranteed and can fluctuate. That's why it's so important to do your research, understand your risk tolerance, and perhaps most importantly, think long-term. The market has always had its ups and downs, but historically, over long periods, it has tended to trend upwards. So, to recap, the stock exchange is an organized marketplace for buying and selling shares of public companies. Companies use it to raise money for growth, and investors use it to potentially grow their wealth. Prices are driven by supply and demand, which in turn are influenced by everything from company profits to the global economy. And indexes, like the S&P 500, help us track the market's overall performance. It's a complex, dynamic system, but at its core, it's powered by a simple idea: connecting companies that need money with people who want to invest it, creating opportunities for growth and prosperity for everyone involved. I hope this has demystified the stock exchange for you a little bit. It's a fascinating world, and understanding the basics is the first step towards becoming a more informed citizen and investor. If you found this video helpful, please give it a thumbs up. And don't forget to subscribe for more videos where we break down complex topics into simple, easy-to-understand explanations. Have any questions? Drop them in the comments below. Thanks for watching, and I'll see you in the next one.